There's a famous quote that says making predictions is hard, especially about the future, and it's no surprise that people have tried to make predictions about the stock market since it was created. If there was a way to reliably predict the future, you can be sure that whoever was able to do it would be rich beyond their wildest dreams. They'd just buy up all of the great stocks at the lowest prices and sell them right at the top every time. Oh, and not to forget, they'd probably just play the lottery and win every time. They'd have enough money to join Elon Musk on his yacht and finally get their tan on. The problem is we don't know the future. Basically, we haven't got a clue, but we still like to make predictions either way. Outside of the finance world, here are my 3 favourites that I found earlier today. The horse is here to stay, but the automobile is a novelty, a fad. Rail travel at high speeds isn't possible because passengers unable to breathe would die of asphyxia. Mobile phones will absolutely never replace the wired telephone. And that's from the guy who invented them. Back in the finance world in present day, lots of people are making all sorts of predictions about whether or not we're currently in a recession, if we've still got another 30% or more to go on the downside, and whether they should just hold cash right now, preparing for the worst. I mean, if you're Robert Kiyosaki, the author of Rich Dad Poor Dad, you're always ready for a recession. He's predicted a few dozen over the last few years. The problem, as you can see, is that anyone can make predictions, but can any of them be trusted? Should we pay attention to any of these signs or just ignore all of the analysis and carry on regardless? Well, there's only one way we're going to find out in one of my videos. Let's have a look at some of the data, take some lessons from the past and see if any of this is worth paying attention to. Mark Twain said that history doesn't repeat itself, but it rhymes. And you could say that this applies pretty accurately with the stock market. We go through cycles of boom and bust, but we're never really quite sure where we are at any one point. There are some hints though. When things are riding high, you can be sure that everyone will be very optimistic, everyone will keep saying that stocks will only go up, and you can be sure that highly speculative stocks that don't yet make a profit will be on everyone's lips. If 2021 was anything to learn from, we can all agree that lots of these kinds of behaviours happened. The same happens on the way down. You get to a point where people are so pessimistic and so negative that you'd think the stock market was about to go to zero. At the moment, there's lots of talk about a possible recession, which is seemingly now pretty likely to take place in the US, at least on a technical level. 2 quarters of negative GDP growth in a row seems to be an almost certainty at the moment, as we've already had last quarter's numbers confirmed. As I discussed in a previous video, the Atlanta branch of the Federal Reserve in the US is already predicting this to be the case using their GDP Now analysis. But the issue is, if this is already a given, what does this mean for the stock market and the wider economy? Because none of this is a secret. If we're all expecting it to happen, then it's not like we've got some insider knowledge. In the UK, we're not quite seeing the same thing. Instead, we're plodding along with very slow growth. Our latest data shows a whopping 0.5% growth from May. We really are moving. Outside of GDP, analysts and economists all like to look at other major sets of data like employment, how many people are in work, savings, how much people have left, and all things like personal debt too. All these things can be interesting. For example, during a recession, we'll obviously see more than 2 quarters of a decline in GDP, as we've just defined, but also we'd expect jobs to decline with more people out of work as consumers spend less money in the economy, which has a knock-on effects to businesses. If people have less money to spend, businesses have to make less stuff for us to buy, and this leads them to not need to spend as much on their own resources, on staff, parts, logistics, you name it. It all flows down the chain, all the way back to the providers of all those raw materials. One of the most famous predictors of market crashes is Michael Burry, and if you've not been living under a rock for the last few weeks, you would have seen almost every popular finance YouTuber make a video about his cryptic tweets. There's nothing we like more than doomsday predictions. Now, to give credit where credit's due, Burry did predict one of the greatest market crashes of all time in the run-up to the financial crash back in 2008. And the guy is super smart and switched on. There is absolutely no denying that. But I'm not sure he knows how Twitter works when he decides to make a post and then just delete it. There's multiple accounts that copy it for the world to see, but hey, maybe that's part of the charm. In one of his recent tweets, he spoke about how the market was down around 25% once adjusted for inflation, because investors are wanting to pay less for stocks, which reduces multiples like price to earnings, for example. He goes on to say that we're maybe halfway there as earnings are set to be reduced even more. The bottom line for this kind of comment is that we just don't know what will happen with companies' earnings. Currently, we're at the highest level of earnings per share we've ever seen. That's the actual profits that companies generate. Here on this chart, we can see how the earnings per share correlates to the overall price of the S&P 500. As you might expect, the amount of profits that companies generate moves pretty closely to the price of the overall index. And as the earnings grow, so does the overall trend of the market being valued greater. Sometimes earnings per share is higher than the price investors are willing to pay, and sometimes it's the other way around. It's just another part of the market cycle. There's no doubt that there's a lot to be scared of right now in the world. We've got conflicts in Europe, high inflation, fears of increasing interest rates, supply chain issues, and so on. Almost everyone agrees that these will have negative effects on businesses who have to try and navigate these problems and keep their heads above water and keep delivering profits back to shareholders. The start of the year has already seen the stock market enter into a bear market, which we can attribute to all of these fears coming together at once. The issue we now have is asking the question about whether or not there's more pain to come or if we're back on the way up. The last month has seen the stock market rally almost 5% higher than it was during the lowest part of the year, and even yesterday as I filmed this video, the market rallied, leading some people to think that maybe the pain is over, and others to think that this is just one of these bear market rallies that are pretty common even in downturns. One of the most intense bear market rallies took place during the dot-com crash between 2000 and 2002, and the market rallied 25% higher after 108 days. So clearly it's something that can happen and will probably happen again. Unfortunately, it didn't end so well, but then went sideways for a bit before taking another dip later on. What about all of the big banks out there? What do they think will happen this year? After all, these guys are on the ground processing huge amounts of cash and manage billions of dollars in assets. If you take a look at all of their predictions for the S&P 500 this year, they look like this. They range from a low of 3,600 points all the way to 4,900. Bear in mind that right now the S&P 500 is currently sitting at just above 3,900 points. So 2 out of the 15 banks here think we're going to stay flat or go a bit lower by year end, and then all of the rest think there's some more optimism to take place. The highest prediction is by JP Morgan Chase at 4,900 points. I think we'll check back at the end of the year to see how those guys get on. Taking an average, the predictions are around 4,400 points. Whether you want to pay attention to any of this is completely up to you. I think you might be beginning to see some of the problems with trying to predict what will happen to the prices in the stock market. Even the biggest institutions have wide-ranging predictions, and there's always going to be people out there who are permanently bearish on the market because, let's be honest, it sells a few more papers and also makes much more clickable headlines. Remember that as humans, our psychology is drawn towards doom and gloom as we hate the fear of losing. We've got a bias toward loss aversion as we fear the pain of losing something twice as much as the opposite feeling of making a gain. It's why when we see headlines of crazy predictions that look like we're all about to walk into oblivion, that we're drawn to it. Pretty much like all of the thumbnails on YouTube with red arrows, shock faces and fire. Sorry guys, sunshine and rainbow just doesn't get the brain as excited. Okay, so we're still kind of left trying to work out if the stock market has bottomed out yet. There's obviously not a single one thing that we can look at that gives us the indicator, because if it was all that simple, it would defeat itself, because all of us investors would then be watching it and then jumping on, trying to preempt each other's behavior. Let me turn the question back to you. Why do you want to know if the market's bottomed out yet? Is it because you've got cash ready to invest, or you're not quite started out yet? Or maybe, quite rationally, you don't want to be that guy who puts in all of their cash just to see it lose another 50% in a few weeks' time. I think the question itself about whether the market is bottomed is probably not the question you should be asking at all, and here's why. First off, let's say you've got cash and you want to invest right now, but you're worried. Let me ask you another question. Is this money you invest right now going to be the only cash you ever invest during your whole working life? Is this literally your only chance, do or die? Most likely no. If you're a long-term investor, it's just going to be one of these many times you'll buy stocks. So let's be honest, getting a discount on a small fraction of what your overall portfolio could be worth seems a bit silly, no? Secondly, if you're worried that your investments could go down once you have them invested, I'm afraid that's the reality of investing itself. And it's also why, as an investor, you'd ideally like to make sure that any money you do invest is cash that you don't need. It's the whole point of talking about basic concepts like an emergency fund to take care of your living costs. In the short term, truly anything could happen in the stock market, as we can see. On any given day, it's a toss-up about whether the market will go up or down, pretty much the same in any given week or month. But as we slowly increase our time horizons, the odds turn into our favour and we start to get more and more chances of our investment increasing in value, at least if we invest in the whole market itself. I know I've shown this chart before, but honestly, it's worth checking it again. The long-term results of the S&P 500 speak for themselves, and yes, sure, we can't use this to predict exactly what will happen in the future. It does show us that even large downturns in the economy that might lead to recessions and crashes really mean very little in the long run. After all, if we've got 10, 20 or 30 years to invest, we're going to have lots of chances to invest. And as we already know, if we invest consistently throughout all of the noise, we'll give ourselves the best chances to come out on top, as we'll buy the stock market when it's cheap and we'll buy it when it's expensive, but our average price will still provide us with growth that will compound amazingly over time. Based on averages, the stock market has returned around 10% per year back to shareholders for the long run, but it doesn't care if you've timed the market perfectly one time back in 2022, because apparently you know that there's still 30% left to drop. Here's one more thing to realize, and another quote I like to remind myself of: the market can stay irrational longer than you can stay solvent. When I think of this, I'm reminded that even with all of the noise in the media and scary thumbnails on YouTube, the stock market doesn't have to do anything rational at all. High interest rates doesn't mean the stock market has to fall. Oil prices moving lower doesn't mean an automatic rally. Great results from a company's earnings doesn't even mean a rise of a set percentage. It's a free-for-all market driven by so many factors. It's a game in a stadium, but there's no lines, no referees, nobody's wearing the same kit. We're not sure who's on the same team or even when the half time is. Rather than trying to pick the winner or guessing that the stock market is still going to go lower, isn't it more important to make sure that you can invest regularly and control what you can invest, rather than worrying about how a certain macroeconomic event might suddenly affect the stock market this week? I know it's fun to play the game in the short term, but if you're in this for the long term, then how you behave and how you act is surely the most important thing to focus on, rather than looking at another Kiyosaki quote or a Michael Burry tweet. After all, if Robert really thinks the dollar's going to zero, then he's going to have to change the price of his book to be in Bitcoin and all of his courses showing you how to get rich too. Don't drink the Kool-Aid, guys. Run as fast as you can. If you want to keep track of what I'm investing in and how I'm sticking with the plan, don't forget to check out all of my portfolio updates. I'll pop the latest one here, which you can enjoy. And until next time, happy investing.